core of value investing, discovering high value hidden behind low prices. John Neff built his reputation on a philosophy that was both deceptively simple and remarkably powerful. True value lies beneath the surface, rarely visible to the untrained eye. For Neff, the mission of an investor was not to hunt for cheap stocks, but to uncover high-quality businesses temporarily mispriced by an emotional market. He often described the stock market as a noisy bazaar, crowded with speculators chasing rumors, trends, and flashy promises. Meanwhile, the true treasures sat quietly in the corner, ignored because they lacked glamour or excitement. Neff thrived in these forgotten corners. He believed that the market's greatest inefficiencies didn't come from complex financial models, but from human psychology, fear, impatience, and herd mentality. To him, a low share price meant nothing without solid fundamentals beneath it. He sought out companies with consistent, reliable earnings, clear business models, honest management teams, real cash flow, not theoretical projections. Neff had a habit of digging into annual reports the way a detective examines a crime scene, searching for clues others missed, questioning every number, and trying to understand the story behind the numbers. If a company was profitable, financially stable, and well-managed, yet still trading at a bargain price, he knew something special was unfolding. These were the moments he lived for. He loved situations where the market overreacted, when a short-term setback caused investors to panic and sell off a fundamentally strong company. To Neff, these events were not crises but golden opportunities. He often said, "Value investing works because people hate being patient." And patience was precisely what separated him from everyone else. Neff's genius came from his ability to stand still while others ran. He waited for the right moment, analyzed with cold logic, and struck only when he saw genuine value. He learned to trust his research even when the rest of the market disagreed. In those quiet moments, when a great company was ignored, misunderstood, or underestimated, Neff stepped in and planted the seeds of exceptional long-term returns. At its core, his philosophy reminds investors that value rarely shouts, it whispers, and only those willing to look deeper, think independently, and resist the noise of the crowd will hear it. If you want, I can now. The power of low PE and steady growth. John Neff's investment approach revolved around one principle so elegant and effective that it became his signature. Combine a low PE ratio with steady, reliable growth. To him, this formula was not merely a financial strategy, it was a shield against the chaos and irrationality that often dominate the market. In Neff's eyes, high PE stocks were like high-speed cars on slippery roads, fast, flashy, and dangerously unpredictable. Investors adored them because they promised thrilling growth and spectacular returns. But Neff had seen too many of these market darlings crash under the weight of impossible expectations. He believed that sky-high valuations turned good companies into ticking time bombs, where the slightest earnings miss could trigger a massive sell-off. Instead, Neff gravitated toward low PE stocks, the ones the crowd found too boring, too slow, or too ordinary to bother with. These were companies sitting quietly in the shadows, trading far below their intrinsic value simply because they lacked hype. He saw value where others saw dullness. Yet Neff was not a bargain hunter who bought cheap companies for the sake of being cheap. He demanded steady, dependable earnings growth, ideally in the range of 7 to 12% annually. To him, this level of growth was achievable, sustainable, more predictable than the explosive, fragile growth that momentum traders worshipped. This combination, low expectations plus solid growth, created what Neff called the embedded margin of safety. It allowed him to buy companies that could deliver consistent returns without needing miracles, breakthroughs, or viral popularity. In other words, he didn't gamble on hope. He invested in likelihood. Neff's approach shined brightest during volatile market cycles. When fear surged, high-growth stocks swung wildly, but Neff's low PE picks held firm like anchors. When optimism returned, these undervalued gems quietly delivered strong gains as the market finally recognized their true worth. His discipline was legendary. While others chased hot trends, tech bubbles, speculative manias, overnight sensations, Neff calmly turned his attention to stable companies with modest growth and realistic valuations. He often said that a low PE isn't just a number, it's a promise of resilience. In the end, Neff's philosophy proved that you don't need dazzling growth to achieve extraordinary returns. You need patience, rationality, and the courage to choose slow and steady when everyone else is choosing fast and flashy. If you want, I can now. Dividends, the hidden engine behind compounding wealth. To most investors, dividends are an afterthought, small payouts that seem insignificant compared to the thrilling allure of fast-growing stocks. But to John Neff, dividends were nothing short of a secret engine of long-term wealth, a financial force quietly shaping the destiny of patient investors. Neff viewed dividends as proof that a company wasn't just making promises, but actually generating real, tangible cash. In a world filled with hype, projections, and optimistic narratives, dividends were the unshakable truth. He believed that any company willing to consistently share its profits with shareholders was demonstrating financial discipline, operational strength, and responsible leadership. But Neff didn't chase dividends blindly. He wanted the perfect balance, a high dividend yield, ideally, above the market average, backed by strong free cash flow, supported by a sustainable payout ratio, managed by leaders with a long-term mindset. To him, dividends were not mere extra income. They were a built-in return, a steady stream of profit that continued flowing even when markets turned violent or unpredictable. Neff often described dividend-paying stocks as quiet warriors, companies that fought for investors day after day, not with flashy headlines or sudden price spikes, but through consistent and dependable performance. While momentum traders obsessed over dramatic quarterly earnings beats, Neff focused on the relentless compounding power of reinvested dividends. Every payout was a seed. Every reinvestment was a new root in the soil of long-term wealth. One of Neff's favorite scenarios was the undervalued dividend gem, a stable, profitable company with a high yield, ignored by the market because it wasn't exciting enough. For him, this combination was pure gold. He knew that when the market eventually woke up to the company's true value, investors would enjoy not only price appreciation, but also years of accumulated dividends. During bear markets, when fear dominated and stock prices collapsed, Neff's dividend-rich portfolio served as a shock absorber. Even when stock prices fell, dividends kept coming, cushioning the downturn and providing psychological strength. Instead of panicking, Neff saw these moments as opportunities to accumulate more shares at bargain prices while still collecting income. In the long run, this unwavering focus on dividends helped him achieve extraordinary compounded returns, proving that real wealth is not built on excitement, but on consistency, discipline, and cash flow that never stops working. If you want, I can now. The courage to go against the crowd. John Neff understood one of the most uncomfortable truths in the world of investing. The crowd is usually wrong. The market behaves like a living creature driven by fear, excitement, impatience, and waves of collective emotion that crash suddenly and violently. While others were swept away by these emotional storms, Neff chose to anchor himself in logic, discipline, and independent thinking. To him, the market's extreme reactions, panic selling or euphoric buying, were not threats but opportunities. He believed that value reveals itself most clearly when emotions run wild. During times of mass fear, when headlines screamed disaster and investors fled like a frightened herd, Neff stepped forward. These were the moments he thrived in. He used to say, when everyone else is shouting, that's when you must learn to listen quietly. Neff's contrarian mindset was not born from arrogance, but from years of watching how emotion distorts reality. He witnessed strong companies being punished simply because the market temporarily lost confidence. He saw investors dump shares without thought, driven by a desperate need to protect themselves from imagined worst-case scenarios. And in those chaotic moments, Neff kept his composure. He approached market panic with the calmness of a surgeon in an operating room. While others saw chaos, he saw mispricing. While others feared the collapse, he asked, has the company's true value changed or just people's emotions? If the fundamentals remained solid, Neff moved swiftly and decisively, often buying when the selling pressure was so extreme that even seasoned investors hesitated. These bold moves allowed him to secure positions in high-quality companies at prices the market would later realize were absurdly low. His courage to go against the crowd wasn't limited to bear markets. In euphoric phases, when investors abandoned logic to chase soaring, overhyped stocks, Neff stayed firmly on the ground. He avoided companies that everyone else loved, understanding that popularity inflates expectations to dangerous levels. He knew the higher the excitement, the sharper the fall. This discipline set Neff apart. He didn't care about being right in the moment. He cared about being right in the long run. He trusted analysis over emotion, patience over speed, and conviction over conformity. Neff's philosophy reminds us that fortunes are rarely made by following the crowd. They are made by those who can stay rational in irrational times, who can remain calm amidst market hysteria, and who dare to walk confidently in the opposite direction when everyone else runs. If you want, I can now. Practical wisdom, slow, steady, and focused on business reality. John Neff's investment philosophy was not shaped in the ivory tower of theory, but forged in decades of real-world experience filled with market crashes, irrational bubbles, corporate scandals, and unpredictable surprises. Through it all, Neff developed a style grounded in practical wisdom, the kind that outlasts trends and survives every market cycle. Neff believed that to invest well, one had to understand a business with the familiarity of a longtime friend. He rejected the notion of buying a stock simply because it looked cheap or because experts on television praised it. Instead, he insisted on peeling back every layer of the business. How does it make money? What keeps customers coming back? Where do the cash flows truly come from? Does the management team have integrity, or do they hide behind clever words? To Neff, the character of a company mattered as much as its numbers. He had seen too many firms boast impressive earnings while masking deep structural problems beneath accounting tricks or aggressive borrowing. Numbers could lie, but cash flow rarely did. And management honesty? That was everything. Neff approached investing like a craftsman. He studied financial statements with discipline, looked for patterns others ignored, and always asked whether growth was real or merely temporary. He avoided businesses built on hype, preferring companies with solid foundations, even if they weren't glamorous. One of his favorite tools was the PEG ratio, which compares valuation to earnings growth. A low PEG signaled a stock that was not only undervalued, but undervalued relative to its potential. It was a powerful filter that helped him distinguish genuine opportunities from value traps disguised as bargains. But perhaps the most important aspect of Neff's wisdom was his devotion to the idea that slow and steady wins the race. He rejected the market's obsession with spectacular returns and overnight riches. In his view, wealth built slowly was wealth that endured. Spectacular gains often came from speculative risks, but steady compounding came from discipline and patience. Neff's approach demanded emotional resilience. When markets surged and others chased hype, he stayed grounded. When markets collapsed and fear dominated, he stayed rational. He trusted the long-term trajectory of strong businesses, even when the short-term noise screamed otherwise. In the end, his legacy proves that great investing is not about brilliance or luck. It is about consistency, clarity, transparency, and the courage to follow reality instead of fantasy.